Question 1. Regulatory framework. Which of the following scenarios would most likely require a captive insurer in Washington to pay a self-procurement tax? A. A captive insurer licensed in Washington underwrites a policy for a Washington-based parent company. B. A Washington-based company purchases coverage from its offshore captive insurer that is not licensed in Washington. C. A captive insurer formed in another state underwrites a policy exclusively for its out-of-state affiliates. D. A captive insurer domiciled in Washington reinsures risks for a traditional insurance company. Answer: B. Explanation. A. Incorrect. If the captive insurer is licensed in Washington and underwrites a policy for a Washington-based company, the insurer is subject to premium taxes, not self-procurement taxes. B. Correct. When a Washington-based company purchases insurance from an offshore captive that is not licensed in Washington, self-procurement tax applies per Washington Revised Code ROB 4814095. This tax ensures that the state captures revenue from non-licensed transactions involving Washington risks. C. Incorrect. Transactions involving out-of-state affiliates and non-Washington domiciled captives do not fall under Washington's jurisdiction for self-procurement taxes unless the risks are located in Washington. D. Incorrect. Reinsurance transactions involving a Washington licensed captive insurer are typically regulated differently, focusing on reserve requirements and solvency standards rather than self-procurement taxes. Question 2. Financial aspects of captive insurance. A captive insurer domiciled in Washington reports a combined ratio of 95% in its financial statement. Which of the following best describes the financial position implied by this ratio? A. The captive is unprofitable due to high operating expenses. B. The captive has a positive underwriting profit, indicating strong financial health. C. The captive is in compliance with Washington's solvency standards but has low liquidity. D. The captive has incurred losses, necessitating additional capital contributions. Answer: B. Explanation. Combined ratio. This is the sum of the loss ratio and expense ratio, representing the percentage of premium income spent on claims and operating expenses. A. Incorrect. A combined ratio below 100% indicates profitability, so this choice misrepresents the captive's performance. B. Correct. A combined ratio of 95% means the captive retains 5% of its premium income as profit before investment income, signaling a sound underwriting strategy. This aligns with Washington's regulatory expectations for solvency under RCW 4831115. C. Incorrect. While a low combined ratio supports solvency, it does not directly address liquidity, which depends on cash flow and asset management. D. Incorrect. Losses are indicated by a combined ratio above 100%, not below. Question 3. Scenario-based question on ethical considerations. Mr. Carter is the CEO of a manufacturing company based in Washington. His firm uses a pure captive to cover risks, including property damage and product liability. Recently, Mr. Carter discovered that a significant portion of the captive's investments is in high-risk speculative assets. The captive's board includes Mr. Carter's family members, who approved these investments without consulting the captive manager. What is Mr. Carter's most appropriate course of action to ensure compliance with Washington's ethical and governance standards for captives? Say, retain the current investments but seek approval from the captive manager retroactively. B. Replace family board members with independent directors and review investment policies. C. Increase capital contributions to offset potential investment losses and avoid regulatory scrutiny. D. Restructure the captive as a group captive to diversify board governance responsibilities. Answer: B. Explanation. A. Incorrect. Retroactive approval does not address the fundamental governance issues or meet Washington's ethical standards for captive operations. WAC 284128. B. Correct. Washington requires captives to maintain transparent governance structures with independent oversight, replacing family members with independent directors, and establishing prudent investment policies aligns with regulatory expectations for ethical management. C. Incorrect. Increasing capital does not rectify governance or compliance issues, nor does it address risks tied to speculative investments. D. Incorrect. Restructuring as a group captive may introduce more diverse governance but does not resolve the immediate compliance and ethical concerns with the current board. Question 4. Risk management principles. Which of the following best describes the purpose of a feasibility study when establishing a captive insurer? A. To determine whether the captive can offer lower premiums than traditional insurers. B. To evaluate whether the captive can meet regulatory solvency requirements in Washington. C. To identify the most suitable investment opportunities for the captive's reserves. D. To assess the operational cost of running a captive insurer in Washington. Answer B. Explanation. A. Incorrect. What cost savings may be a benefit? The primary purpose of a feasibility study is to assess financial and regulatory viability, not just to compare premiums. B. Correct. A feasibility study is a thorough evaluation to ensure the proposed captive can meet the regulatory and solvency requirements set by Washington Law, IABLA 48.31. This includes ensuring the captive's ability to meet liabilities and maintain adequate reserves. C. Incorrect. Investment strategies are part of operational planning but are secondary to evaluating solvency and legal compliance. D. Incorrect. While operational costs are a factor, the feasibility study primarily focuses on financial viability and regulatory compliance, not just costs. Question 5. Legal and contractual considerations. Which of the following is typically required in the development of a captive insurance policy form in Washington? A. The policy must be approved by Washington's Office of the Insurance Commissioner, OIC. B. The policy must comply with the terms and conditions of a group captive agreement. C. The policy must provide full coverage for all risks without exclusions. D. The policy must be developed by an independent third-party underwriter. Answer A. Explanation. A. Correct. Washington state law requires that captive insurance policies comply with applicable regulations and are subject to approval by the Washington Office of the Insurance Commission, IABLA 4831150. This ensures that the terms of the policy align with regulatory standards. B. Incorrect. Group captive agreements are a type of structure, but they do not dictate policy terms unless specified in the agreement. C. Incorrect. Full coverage with no exclusions is not a requirement. Policies must comply with statutory minimums, but exclusions can be included within the bounds of the law. D. Incorrect. A captive insurer can develop its own policies if third-party underwriters are not mandatory for policy creation. Question 6. Washington-specific captive insurance requirements. Which of the following is a key requirement for forming a captive insurer in Washington? A. The captive must have a minimum of 50 policyholders. B. The captive must have sufficient capital to meet state regulatory solvency requirements. C. The captive must operate in multiple states before being licensed in Washington. D. The captive must underwrite all types of insurance products, including life and health coverage. Answer B. Explanation. A. Incorrect. Washington does not require a minimum number of policyholders for captive formation. Instead, the focus is on financial and regulatory compliance. B. Correct. Washington requires captives to meet specific solvency standards, including maintaining minimum capital as per RCW 4831040. This ensures the captive can cover its liabilities. C. Incorrect. Captives can be domiciled and licensed solely in Washington, and multi-state operations are not required. D. Incorrect. Captives are often specialized in certain types of insurance coverage, e.g. property liability, but are not required to underwrite all insurance products, including life and health. Question 7. Financial aspects of captive insurance. Which of the following best describes how Washington state evaluates the solvency of a captive insurer? A. By reviewing the captive's dividend distributions to its policyholders. B. By ensuring the captive's premiums are higher than its claims and expenses. C. By comparing the captive's financial statements with those of traditional insurers. D. By assessing the captive's reserves, including both loss and unearned premium reserves. Answer D. Explanation. A. Incorrect. Dividend distributions to policyholders do not directly indicate solvency. Solvency is primarily assessed based on the captive's ability to meet its obligations. B. Incorrect. While underwriting profitability is important, solvency is more closely linked to reserves and the ability to pay claims, not just premium levels. C. Incorrect. While comparisons with traditional insurers may be useful for context, Washington focuses on specific solvency measures tailored to captives, including reserve requirements. D. Correct. Washington evaluates captive solvency by ensuring the captive maintains adequate reserves, including loss and unearned premium reserves, in accordance with regulatory standard IABLA 31200. Question 8. Risk management principles. When establishing underwriting guidelines for a captive insurance operation in Washington, which of the following is the most important factor to consider? A. The maximum premium rates that can be charged to policyholders. B. The specific risks covered and the corresponding loss exposures. C. The geographic location of the policyholders. D. The use of non-traditional insurance products to diversify the risk portfolio. Answer B. Explanation. A. Incorrect. While premium rates are an important part of underwriting, the focus of underwriting guidelines is on the risks being insured rather than rate caps. B. Correct. Underwriting guidelines should be based on the specific risks being covered, as this dictates the captive's risk exposure and necessary reserve levels. Washington Regulation RA Bureau 831050 emphasize a risk-based approach to underwriting. C. Incorrect. Geographic location affects underwriting, but is secondary to understanding the risks covered and exposures. D. Incorrect. While diversification of risk can be part of a broader strategy, the primary concern for underwriting is understanding and mitigating the specific risks the captive is insuring. Question 9. Ethical considerations and best practices. A captive insurer in Washington discovers that one of its senior executives has a conflict of interest, as they are also a director of a company that is a major policyholder. What is the most appropriate action the insurer should take? A. Allow the executive to continue in their role, but disclose the conflict to the captive's board. B. Terminate the executive's position immediately to maintain ethical standards. C. Seek legal counsel to determine if the conflict is significant enough to require resignation. D. Allow the executive to retain both roles as long as they do not vote on policies related to their company. Answer C. Explanation. A. Incorrect. Simply disclosing the conflict of interest does not necessarily resolve the ethical concerns. Washington law requires active management of conflicts to ensure they do not compromise the insurer's operations or policyholder interests. B. Incorrect. Terminating the executive may be premature without a full assessment of the situation and its impact. C. Correct. Seeking legal counsel ensures that the conflict of interest is appropriately addressed according to Washington's ethical standards for captive insurers, including potential remedies such as resignation or divestment from the conflicting entity. WAC 284128. D. Incorrect. Allowing the executive to retain both roles without addressing the potential for undue influence violates best practices for governance and conflicts of interest management. Question 10. Washington-specific captive insurance requirements. Which of the following is a specific filing requirement for captive insurers domiciled in Washington? A. Submitting an annual actuarial report to the Office of the Insurance Commissioner, OIC. B. Filing a quarterly report with the Washington State Auditor's Office. C. Reporting all reinsurance transactions with non-Washington entities. D. Submitting a certificate of insurance for all policies underwritten by the captive. Answer A. Explanation. A. Correct. Washington requires captives to submit annual actuarial reports to the Office of the Insurance Commissioner, OIC, as part of their regulatory filing RW 4831130. This helps ensure that the captive's reserves and financial health are adequate. B. Incorrect. The State Auditor's Office is not involved in the filing process for captive insurers. Now, this is primarily the responsibility of the OIC. C. Incorrect. While reinsurance transactions may need to be reported, the key filing requirement is the actuarial report and annual statement, not reinsurance details. D. Incorrect. A certificate of insurance is typically not required to be submitted to the OIC unless requested in specific cases. Question 11. Regulatory framework. Which of the following is a primary role of the Washington Office of the Insurance Commissioner, OIC, regarding captive insurers? A. Setting the premiums charged by captive insurers. B. Approving the business plan and financial statements of a captive insurer. C. Reviewing claims submitted by policyholders of captive insurers. D. Managing the claims payment process for captives in the state. Answer B. Explanation. A. Incorrect. While the OIC oversees the regulatory framework, it does not directly set premiums for captive insurers. B. Correct. The OIC's primary role includes approving the business plan and reviewing financial statements of captive insurers to ensure compliance with regulatory requirements. C. Incorrect. The OIC does not typically manage individual claims. This responsibility rests with the captive insurer. D. Incorrect. Claims payments are managed by the captive insurer, not the OIC. Question 12. Capital requirements for captive insurance. What is the minimum capital requirement for a single-parent captive insurance company in Washington? A. $500,000. B. $1 million. C. $2 million. D. $3 million. Answer B. Explanation. A. Incorrect. Washington's capital requirements are higher than $500,000 for a single-parent captive insurer. B. Correct. Washington requires single-parent captives to maintain a minimum capital of $1 million. ARIA Bureau 831040. C. Incorrect. $2 million is not the required capital minimum for A single parent captive in Washington. D. Incorrect. Washington does not set a $3 million capital requirement for single parent captives. Question 13. Insurance coverage restrictions. Under Washington law, which type of insurance coverage can a captive insurer (NOT) provide? A. Life insurance. B. Commercial property insurance. C. Workers' compensation insurance. D. Liability insurance. Answer: A. Explanation. A. Correct. Washington law does not allow captives to provide life insurance. Captives are typically limited to covering commercial property liability and workers' compensation insurance, but not life insurance. B. Incorrect. Captives can provide commercial property insurance. C. Incorrect. Captives can provide workers' compensation insurance depending on their business plan. D. Incorrect. Captives can provide liability insurance. Question 14. Risk retention and management. Which of the following best describes a risk retention group, or RG, in Washington? A. A captive insurer that operates outside of state regulation. B. A type of group captive formed to insure risks of its members. C. A form of self-insurance that does not require regulatory approval. D. A pool of insurance companies that share risk for large commercial clients. Answer: B. Explanation. A. Incorrect. RRGS are regulated under state law, specifically the Federal Liability Risk Retention Act, and must meet state requirements. B. Correct. A risk retention group, RRG, is a type of group captive insurer formed by businesses to insure the liability risks of its members. C. Incorrect. RRGS require regulatory approval to ensure solvency and compliance with state insurance laws. D. Incorrect. While RRGS share risks, they are not a pool of multiple insurance companies, but a single entity formed by its members. Question 15. Investment requirements. What is a key investment requirement for captive insurers in Washington? A. Captive insurers must invest primarily in stocks of publicly traded companies. B. Captive insurers must invest only in bonds issued by Washington state. C. Captive insurers must maintain a diversified investment portfolio to protect policyholders' assets. D. Captive insurers must reinvest all premiums into their insurance operations. Answer: C. Explanation. A. Incorrect. While investments in stocks may be allowed, captives are not required to invest primarily in publicly traded companies. B. Incorrect. Captive insurers are not restricted to investing in bonds issued by Washington state. C. Correct. Washington law requires captive insurers to maintain a diversified investment portfolio to mitigate risk and ensure the security of policyholders' assets. D. Incorrect. Premiums are used to cover claims, expenses, and reserves, but not all premiums must be reinvested into operations. Question 16. Risk pooling arrangements. Which of the following is true about a rent-a-captive arrangement in Washington? A. The rent-a-captive must be formed as a fully independent insurer. B. The participant in a rent-a-captive does not need to maintain its own capital. C. The rent-a-captive can only insure risks for the owner of the facility. D. Rent-a-captives are not regulated by Washington state law. Correct answer: B. Explanation. A. Incorrect. A rent-a-captive does not need to be fully independent. It allows a company to rent the capital and infrastructure of an existing captive. B. Correct. In a rent-a-captive arrangement, the participant does not need to provide capital as it uses the capital of the existing captive for coverage. C. Incorrect. Rent-a-captives can insure a range of risks, not only those related to the facility owner. D. Incorrect. Rent-a-captives are regulated under Washington state law with specific requirements for operation. Question 17. Regulatory oversight. Which of the following reports must a captive insurer in Washington submit annually to the Office of the Insurance Commissioner, OIC? A. A risk management report detailing the insurer's claim history. B. A detailed actuarial report on financial statements. C. A report on the executive compensation of the insurer's officers. D. A summary of claims paid and outstanding liabilities. Answer: B. Explanation. A. Incorrect. A risk management report is not a required filing, and captives must focus on financial solvency and business operations. B. Correct. Captive insurers are required to submit a detailed actuarial report and financial statements to the OIC annually. This is required by Washington law to ensure solvency and compliance. C. Incorrect. Executive compensation is typically not a required part of annual filings. D. Incorrect. While claims and liabilities may be part of the financial statements, they are not the focus of an annual summary filing. Question 18. Captive insurance taxation. How are captive insurers taxed in Washington? A. Captive insurers are exempt from all state taxes. B. Captive insurers are subject to standard state corporate income taxes. C. Captive insurers are taxed only on premiums collected from their own members. D. Captive insurers are subject to a special insurance premium tax. Answer D. Explanation. A. Incorrect. Captive insurers are not exempt from all taxes if they are subject to certain state taxes. B. Incorrect. Captive insurers may be subject to corporate taxes, but this is not the primary taxation method in Washington. C. Incorrect. Captive insurers are taxed on premiums, but not solely on those collected from their members. D. Correct. Captive insurers in Washington are subject to an insurance premium tax as per the state's taxation rules. Question 19. Captive insurance management. Which of the following entities typically manages the day-to-day operations of a captive insurer in Washington? A. The captive insurer's board of directors. B. A third-party management firm hired by the captive. C. The Washington office of the insurance commissioner. D. The participating policyholders. Answer B. Explanation. A. Incorrect. The board of directors oversees the captive but does not typically manage day-to-day operations. B. Correct. Captives often hire third-party management firms to handle daily operations, including underwriting, claims, and compliance. C. Incorrect. The OIC regulates and oversees captives but does not manage their operations. D. Incorrect. While participating policyholders may have a say in governance, they do not manage the captive's operations directly. Question 20. Claim handling and governance. Which of the following is a best practice for claim handling in a Washington-based captive insurer? A. Claims must be managed by a third-party administrator to ensure impartiality. B. Claims should be paid directly to policyholders without any review process. C. The board of directors must personally approve all claims payments. D. Claims must be reviewed and approved by the Washington office of the insurance commissioner. Answer A. Explanation. A. Correct. Third-party administrators, TPAS, are often used by captives to handle claims to ensure impartiality, efficiency, and compliance with industry standards. B. Incorrect. Paying claims directly to policyholders without any review process could lead to improper or fraudulent claims being paid. A review process is essential for ensuring the validity of claims. C. Incorrect. While the board of directors has governance responsibility, it is generally not practical or efficient for them to personally approve all claims payments. Instead, claims management is typically handled by experienced claims adjusters or third-party administrators. D. Incorrect. While the Washington office of the insurance commissioner, OIC, oversees regulatory compliance, it does not typically approve individual claims. It focuses on ensuring that captives follow the appropriate regulatory frameworks and maintain solvency. Question 21. Risk management for captives. What is a key component of an effective risk management program for a captive insurer in Washington? A. Diversifying insurance policies across multiple states. B. Regularly reviewing claims history and adjusting coverage based on trends. C. Avoiding reinsurance to limit exposure to outside risks. D. Investing in real estate to secure future liabilities. Answer B. Explanation. A. Incorrect. Diversifying policies across multiple states is not a primary risk management strategy for captives, which typically focus on managing specific risks relevant to the captive's owners or participants. B. Correct. Regular review of claims history is essential for understanding risk patterns and adjusting coverage or strategies to mitigate future losses. This is a core aspect of any effective risk management program. C. Incorrect. Reinsurance is often used by captives to reduce risk exposure and stabilize operations. Avoiding reinsurance can expose the captive to higher risk. D. Incorrect. While real estate investments may be part of a broader investment strategy, they are not specifically a core risk management component for captives. Question 22. Captive insurer audits. Which of the following best describes the audit requirements for a captive insurer in Washington? A. Captive insurers must be audited annually by an external auditor who is approved by the OIC. B. Only newly formed captives need to undergo an audit. C. Audits are not required for captives with fewer than 5 policyholders. D. Audits are only required if the captive has more than $10 million in assets. Answer A. Explanation. A. Correct. Washington law requires that all captive insurers undergo an annual audit by an independent external auditor approved by the OIC. This is necessary to ensure the captive's financial stability and regulatory compliance. B. Incorrect. All captives, regardless of their age, must undergo an annual audit. C. Incorrect. Audits are required for all captives, not just those with a specific number of policyholders. D. Incorrect. There is no asset threshold for audit requirements in Washington. All captives must undergo annual audits. Question 23. Captive insurer liquidity requirements. What is a liquidity requirement for captive insurers in Washington? Captive insurers must maintain a certain percentage of their assets in liquid investments to meet potential claims. B. Captive insurers are not required to maintain any liquidity but must rely on their capital reserves. C. Captive insurers must keep all assets in real estate and cash. D. Captive insurers must sell their non-liquid assets if they face an imminent liquidity crisis. Answer A. Explanation. A. Correct. Captive insurers are required to maintain sufficient liquidity, typically in the form of liquid investments, to ensure they can meet their obligations and pay claims when necessary. B. Incorrect. While captives rely on capital reserves, liquidity is still a requirement to ensure they can cover claims and expenses. C. Incorrect. Captives are not restricted to keeping assets only in real estate and cash. They must maintain a balanced investment portfolio to manage risk effectively. D. Incorrect. Selling non-liquid assets is not a general requirement. Instead, captives are expected to manage liquidity proactively by holding liquid investments. Question 24. Financial reporting for captives. Which of the following must captive insurers in Washington include in their annual financial report? A detailed breakdown of the premiums charged to policyholders. B. A list of all risks covered by the captive insurance policy. C. A statement of the captive's solvency and capital adequacy. D. A report on the performance of the captive's claims adjusters. Answer C. Explanation. A. Incorrect. While premium income is part of the financial report, it is not the primary focus of the solvency assessment. B. Incorrect. The financial report focuses on overall financial health, not a detailed listing of individual risks. C. Correct. Captive insurers must include a statement of solvency and capital adequacy to demonstrate that they can meet their obligations and operate in a financially stable manner. D. Incorrect. The performance of claims adjusters is not a primary focus of the financial report, although it may be reviewed in the context of claims management. Question 25. Captive insurance claims reserves. Which of the following is true regarding claims reserves for captive insurers in Washington? A. Captive insurers must set aside claims reserves based on estimated future liabilities. B. Claims reserves are optional and captives can choose not to set them aside. C. Captive insurers must rely entirely on reinsurance to cover claims reserves. D. Claims reserves must only cover claims reported but not yet paid. Answer A. Explanation. A. Correct. Captive insurers are required to set aside claims reserves based on estimated future liabilities, ensuring that they can cover claims as they are reported and as future claims are anticipated. B. Incorrect. Claims reserves are a regulatory requirement, not optional. C. Incorrect. While reinsurance can help manage claims risk, captives must set aside their own claims reserves to meet future liabilities. D. Incorrect. Claims reserves must cover both reported and unreported claims that may arise in the future, i.e., incurred but not reported claims. Question 26. Captive insurance ownership. Who typically owns a captive insurer in Washington? A. A group of unrelated insurance companies. B. The state government of Washington. C. The parent company or a group of related companies that use the captive to insure their risks. D. A third-party insurance firm that manages the captive. Answer C. Explanation. A. Incorrect. Captives are generally owned by a parent company or related companies, not by unrelated insurance companies. B. Incorrect. The state government does not typically own captives. C. Correct. Captives are generally owned by the parent company or a group of related companies that form the captive to insure the risks of the parent group. D. Incorrect. While third-party firms may manage captives, they do not own them. Question 27. Captive insurance regulations. Which of the following is not a requirement for a captive insurer under Washington state law? A. A captive insurer must be licensed by the Washington Office of the Insurance Commissioner. B. A captive insurer must maintain a minimum level of capitalization based on the risks it insures. C. A captive insurer must offer insurance to the general public. D. A captive insurer must submit an annual financial report to the Washington Office of the Insurance Commissioner. Answer C. Explanation. A. Incorrect. Captive insurers must be licensed by the OIC in Washington, which ensures compliance with state regulations. B. Incorrect. Captive insurers must maintain adequate capitalization based on their risk profile to ensure financial stability. C. Correct. Captive insurers are not required to offer insurance to the general public. They are formed to provide insurance coverage for a specific group or parent company. D. Incorrect. Captive insurers are required to submit an annual financial report to ensure solvency and regulatory compliance. This concludes the 10 additional questions. If you need more, feel free to ask. Question 20. Captive insurer governance. What is a common governance structure for a captive insurer in Washington? A. A board of directors consisting of only external auditors. B. The board of directors composed of representatives from the parent company or related companies. C. The parent company's CEO is the sole decision maker for the captive insurer. D. A government-appointed board of directors oversees all captives. Answer B. Explanation. A. Incorrect. While auditors may provide oversight, a board of directors typically comprises representatives from the parent company or related entities, not just external auditors. B. Correct. Captive insurers are usually governed by a board of directors composed of representatives from the parent company or related companies, which ensures that decisions align with the interests of the group being insured. C. Incorrect. While the CEO may have significant influence, governance typically involves a board of directors, not just one individual. D. Incorrect. The board is not government appointed, it is formed by the parent or related companies that own the captive. Question 29. Captive insurer solvency requirements. Which of the following is a solvency requirement for captive insurers in Washington? A. Captive insurers must maintain a minimum surplus level determined by the Washington Office of the Insurance Commissioner. B. Captive insurers are not required to maintain solvency as long as they have sufficient cash flow. C. Solvency requirements only apply to captives that offer coverage for natural disasters. D. Captive insurers can self-assess solvency with no regulatory oversight. Answer A. Explanation. A. Correct. Washington law requires captive insurers to maintain a minimum surplus level, which is set to ensure that the insurer can meet its obligations and remains financially stable. B. Incorrect. Solvency requirements are mandatory for all captive insurers to ensure that they can pay claims and operate without financial instability, not just based on cash flow. C. Incorrect. Solvency requirements apply to all captives, not just those that cover specific types of risks like natural disasters. D. Incorrect. Solvency must be regulated and assessed by the state, and captives cannot self-assess without oversight. Question 30. Captive insurer taxation. Which of the following is a tax-related benefit of forming a captive insurer in Washington? A. Captive insurers are exempt from all state taxes, including income and premium taxes. B. Premiums paid to a captive insurer are deductible as business expenses for the parent company. C. Captive insurers are taxed at a higher rate than traditional insurance companies. D. Captive insurers must pay taxes on their reserves even if they are not distributed. Answer B. Explanation. A. Incorrect. Captive insurers are not exempt from all state taxes, but they may have specific tax advantages. B. Correct. Premiums paid to a captive insurer are typically deductible as business expenses by the parent company, providing a tax benefit. C. Incorrect. Captive insurers may enjoy favorable tax treatment depending on their structure and operations, but they are not taxed at a higher rate than traditional insurers. D. Incorrect. Taxes on reserves are not typically levied until they are distributed or when income is realized.